Stay with us to uncover how the Bank of Japan's accelerating rate hike signals and yen intervention strategy could ignite a global carry trade unwind. Recently, US dollar to Japanese yen has seen significant volatility, plummeting over 40 pips to 162.86. With central bank warnings about persistent inflation, the global equities and risk assets are on high alert. For years, Japan's ultra-low interest rates have set the stage for the global yen carry trade, allowing investors to borrow cheaply in yen to invest in higher-yielding assets worldwide. However, with domestic inflation heating up, the Bank of Japan is hinting at a quicker pace for rate hikes, moving faster than the traditional 6-month cycle. As we approach the BOJ's policy meeting on July 30th and 31st, markets are reassessing the sustainability of current liquidity. Central bankers have made it clear that the weakness of the yen is contributing to broader inflation risks, creating an urgent need for monetary tightening and intervention in currency markets. As we analyze the timeline and market reactions, it's evident that the Bank of Japan is gearing up for a significant policy shift ahead of its monetary policy meeting on July 30th and 31st, 2026. The relentless weakness of the yen, which is escalating inflation concerns, has prompted clear warnings from central bank officials. In response, US dollar to Japanese yen saw a sharp drop of over 40 pips to 162.86, amid rising fears of intervention and expectations of a faster tightening cycle. Meanwhile, Asian equity markets are showing contrasting trends. Despite currency volatility and geopolitical energy risks, the Nikkei 225 gained around 1.9%, while South Korea's KOSPI surged over 6%, driven by a strong rebound in memory chips. Overall, Asia-Pacific markets outside Japan rose by 1.2%. Yet, lurking beneath this surface rally are the risks of forced unwinding. If the BOJ actively intervenes while raising rates, the enormous global carry trade positions that have long supported international risk assets, including the S&P and broader global equities, could face sudden deleveraging pressure. On social media platforms like X, traders and market participants are closely watching these official signals. Many prominent posts indicate that the BOJ is signaling faster rate hikes than previously anticipated, particularly if inflation remains high leading up to the late July meeting. Traders noted that the sudden decline in US dollar to Japanese yen to 162.86 was a direct reaction to intervention anxiety and hawkish commentary from the central bank. Furthermore, macro accounts are highlighting the crucial link between Japanese policy tightening and global markets, warning that a combination of rate hikes and yen strength could lead to a chaotic unwinding of the global yen carry trade. Institutional analysts and market strategists are pointing to a significant shift in how the BOJ is responding to economic conditions. Instead of sticking to a predictable, gradual rate hike every 6 months, analysts are observing that persistent inflation and excessive currency depreciation are compelling central bankers to consider quicker monetary tightening. Financial institutions are stressing that interventions in the currency market, coupled with interest rate hikes, are creating a dual squeeze on short yen positions. Analysts caution that global risk assets, including major indices like the S&P, are at risk of forced selling if global liquidity tightens rapidly due to Japanese capital flowing back home. The anticipation of faster BOJ rate hikes and potential yen strength creates a complicated landscape for Japanese equities. While the Nikkei 225 achieved a 1.9% gain in recent sessions alongside regional rallies, sector divergence is likely to increase. A stronger yen typically pressures major export-driven sectors, while domestic financial stocks may benefit from wider net interest margins under higher rates. Meanwhile, technology and memory chip-related equities have shown resilience across Asia, contributing to Korea's KOSPI's over 6% surge. Looking ahead, investors need to evaluate whether the gains in Japanese equities can be sustained if the yen appreciates and borrowing costs rise. On the global macro front, currency markets are acting as the primary transmission vector. Following the drop in US dollar to Japanese yen to 162.86, foreign exchange volatility has surged across Asian currency pairs. Meanwhile, geopolitical tensions and energy risks persist, testing the resilience of global markets. Since yen-denominated funding has historically supported global risk assets, aggressive tightening by the BOJ, combined with currency intervention, could trigger cross-border deleveraging. If carry trade capital rapidly returns to Japan, global equities and risk assets in Western markets could face significant selling pressure. For individual investors navigating this shifting macroeconomic landscape, managing risk is crucial. First, keep an eye on key dates, especially the BOJ monetary policy decision on July 30th and 31st. Second, monitor US dollar to Japanese yen price volatility near critical technical levels around 162.86, as rapid currency swings can have widespread effects on global portfolio allocations. Third, avoid blindly chasing short-term equity rallies, particularly in sectors sensitive to foreign exchange movements or global leverage. Adopting disciplined position sizing and staying vigilant about liquidity risks will be essential as central bank policies normalize. Based on algorithmic analysis of policy signals and currency flows, we forecast three main scenarios for global markets following the BOJ's July meeting. In the base scenario, with a 50% likelihood, the BOJ signals a clear rate hike during the July 30th to 31st meeting, maintaining active intervention warnings. US dollar to Japanese yen stabilizes between 158 to 162, resulting in moderate carry trade unwinding but allowing global equities to adapt smoothly to the tightening. In the bullish scenario for risk assets, with a 20% chance, the BOJ implements a dovish rate hike, reassuring markets that liquidity withdrawal will be gradual. Here, the Nikkei 225 could rise further towards 41,000, with global risk assets resuming their upward trajectory. In the bearish scenario, with a 30% probability, persistent inflation leads the BOJ to enact an aggressive rate hike, paired with substantial Ministry of Finance foreign exchange intervention. This would trigger a swift drop in US dollar to Japanese yen below 155, forcing a rapid and orderly unwinding of the global yen carry trade, resulting in a 5% to 8% correction in global equities, including the S&P 500. In summary, the Bank of Japan is signaling faster rate hikes ahead of its July 30th to 31st meeting. Yen intervention fears have pushed US dollar to Japanese yen to 162.86, increasing carry trade risks. As a result, global equities are facing a realignment of liquidity. What's your outlook on the yen? We invite you to share your thoughts in the comments, hit like, and subscribe for more in-depth financial analysis.